Hi trainers, welcome to this video. Today I want to talk about how to calculate a position size or how to calculate the number of shares for your trading position correctly. Before we come to this video, please take a few seconds to read this risk disclaimer. So this video is only for educational purpose. And it's not an investment advice. So you are responsible for your own trading decisions. I produced this video because a lot of people wrote emails to me and also asked me on Twitter and also here on YouTube how they calculate a trading position correctly, and how all this different variables, so like total trading capital and risk per share, etc., how they fit together. And I want to explain that in this video. And I want to also give you some background information so that you know why I am as a trader and also a lot of other traders are doing this. And I want to also give you an example how you can do that with a spreadsheet. So let's dive into the video. First of all, we start with a quote or a statement from myself. Position sizing is a powerful tool for me. It helps me to keep my risk at the same amount and reduce the average loss. So here are some keywords inside. A powerful tool. So that means this is very important for me and has a lot of impact on my trading. Then keep the risk at the same amount. So risk management is a very important idea behind position size calculation, and also reduce the average loss. You know, if I am looking at losses, I always look at the average loss, because I'm not interested in the next trade. I'm always interested in how I am doing over a long series of trades, and that's why I'm always looking at average loss and average profits and average hit rate, and not on the single trade or on a small series of trades. Let's come to the first component of this quote. Every trade has the same risk amount. And here again, position sizing is about risk management. You must have that in mind. This is very important. It's not about calculating the right number of shares or something. This is just an outcome of that. But the idea behind everything here is risk management. You want to manage your risk properly. So, and the idea behind risk management and the goal behind risk management is always to stay in the game as long as possible. So you want to survive as a trader. You want to survive different market periods, and you want to be able to trade for 20, 30 or even 40 years without going bankrupt. And when we come to risk management and to position size calculation, there's always this example from casinos. And I think this is a very good explanation. So when you're sitting on a casino table, for example, you always have a fixed risk, and that's your bet or your stake. You put $500 in chips on the table and say, okay, if I lose this game, I only lose $500 and not more. So you always have a stop loss inside your game when you're playing in a casino. You cannot lose more than this $500 you put on the table. And in trading, this is completely different. In trading, you theoretically can lose 100% of your position size. So when you have a trading position of say $10,000 in one stock, and the company goes bankrupt, you have a risk of this $10,000. So you can lose this $10,000 US dollar. And this is different to casinos. Of course, if you look at the same or if you look at the similarities, in both cases you have something like a stop loss. But in a casino case, it's only a very small fraction of your capital maybe. And in trading, it is a very big risk. And you can manage that risk much, much better when you only risk a small fraction of your total capital. So similar to the casino, you are able to do the same thing in trading. You can say, I only want to lose 500 US dollar, although you have a position of 10,000 US dollar. And I will show you that. The second point, which is very important, is every loss should be limited to a consistent amount to avoid big destroying losses. Big losses is the number one problem why the most traders go bankrupt or the most traders give up before they reach their goals. And it's mostly that one or two big losses destroy all your trading capital. And if you have no trading capital, you are not able to trade anymore. So it's very important to protect that. And you are able to limit your risk or your losses to a consistent amount when you do position sizing properly. But if you want to eliminate these big losses, then you have to do an exchange for that. So because if you do not manage your risk and you let your losses run, there are some trades which will come back and go into the profit zone again. And in that case, when you limit your losses, you exchange the big losses for some more small losses. But that's a very good exchange. That's a very good deal. And I will show you that in a minute. And if you limit your risk and limit your losses, the winning trades are much or can pay for those small losses much easier. So if you have, for example, an average loss of 500 US dollar and you have an average win or an average profit in trades of 1,000 US dollar, it's much easier for trades to wipe out a lot of small losses. And here is an example row of trades without position sizing. So keep that only as an example. And I highlighted here two big losses in red. So the first one with 1,500 US dollar, then you have a smaller loss, then you have a profit of 300 US dollar, then a small loss again of 150, and then another big loss of 2,500. And then on your profit, in the profit column, you also have two big winners, so 1,300 and 1,500. And when you look at the last row, you can see all your losing trades, or the sum of your losing trades is 4,800 US dollar, and on the other side, your winning trades make 4,000 US dollar. So this is maybe more a losing strategy. So if you play that strategy long enough, you will lose money. And if you look at the averages here, so the average loss is 800 and the average profit is 800. So they are equal. And then it more depends on the hit rate and if you make money with the strategy or not. So, and if we now put a position size management on top, we eliminate those big losses. Here you can see that. In this example, I limited all losses with stop loss orders and right position size calculation to 400 US dollar. And you can see that we now have one more loss. So I go back one chart, you can see the 300 US dollar is now coming into the losses column here. And the big losses we had here on top, the 1,500 and 2,500, they are now gone and replaced with a smaller loss of 400 because we limited the loss at 400 US dollar. And in that case here, in the case of the 300 US dollar trade, which were a profit before, I put them into the into the loss column because, yeah, this is a typical example. Maybe this was a trade which had been in a negative zone, so were a loser, and it's now were a loser and became a profitable trade again. And yeah, I just put them into the loss column to show you that although we have more losers here, the average loss is now much smaller because we eliminated the big losses. You can see we had an average loss of 800 before, and now we reduced the average loss to 286. And we did that only by eliminating the big losses in that series of trades. And on the other side, in the profit column, we removed this 300 US dollar trade. And in that case, now we have an average profit of 925. Before it was 800. So it is a little bit more, but the hit rate also went down, of course. And in that case, you can see that now the average profit, although we removed one profitable trade, is much higher than the losses. And such a strategy has a much higher chance to produce profits in the long run. So, and limiting your losses is the key to make this strategy profitable. So that was more a theory behind everything. So risk management is always the goal when we speak about position size calculation. But now let's come to the main part: how calculate the number of shares, or the right number of shares. So you start always with a total trading capital, and the total trading capital, in my opinion, is always without open profits and without open losses. So it's more the capital which you have or which you can take without any open profits or any open losses. Because open profits or losses, they can be gone. So they can be wiped out in one day, and you always want to be conservative when it comes to risk management. And in my case, I take 1% from this total trading capital, and in that case here it's 1% from 100,000 US dollar, so it's 1,000 US dollar, and that's the maximum I want to lose as a trader. So of course, this is only in that case when you get stopped out at your preferred price. So when there is a gap or something, of course you will lose more than the 1,000 US dollar. But in that case, we only look at the average trades, and big gap downs are not the usual case. It's much rare or seldom. Okay, and then we now need a second component, and that's the risk per share. And the risk per share is a very simple calculation. You have the entry price and you subtract the stop loss price. So in this example, we assume that we buy a position for 50 US dollar and we put in a stop loss at 47.50. And in that case, we have a risk per share of $2.50. So that means per one share, when we get stopped out, we lose only $2.50. And now that's very easy to do the math or to do the calculation. Because now we can take this 1,000 and divide that by the $2.50. So because what we want to lose as a maximum is we want to lose the 1,000 US dollar as a maximum. And per share, we only want to lose $2.50. So now when we divide the 1,000 through $2.50, we get 400. And that means we can buy 400 shares and lose not more than 1,000 US dollar if we get stopped out. And then, of course, that's another question I get very often from traders. And they ask me, when I take 1% from my total capital, am I able only to trade a position with a value of 1% of my total trading capital? And that's wrong. So because we now know that we can trade 400 shares, and if we now multiply the 400 shares with a 50, we get the position size. And the position size is 20,000. And now you can see that we are able to trade a 20% position. So 20% from my 100,000 total trading capital. We can trade a 20% position and only or limit our risk to 1% of our total capital. That's important. So we can trade big position sizes and only risk a small fraction of our total capital. It's like a casino. We put the 1,000 US dollar on the table and we are able to win much more with that, but limit our risk to 1,000 in that case. So let's come to a more practical example of position size calculation. So you as a trader, you want to buy the stock XYZ when it breaks out above the 100 US dollar mark. So in that case, you place a stop buy order at 105, and when the stock breaks down below the 100 again, you want to be out. So because the trade does not make sense anymore. And that's why you place a stop loss order at 98. So we enter the trade with 105 and we exit the trade in the case of stop loss at 98. And now we, very simple, take the 105, we subtract the 98 from it and we get the risk per share, so it's 7 US dollar. And now let's assume you have a trading capital, so a total trading capital of 50,000, and you have 5,000 open profits in your portfolio. So you always own some shares, and now you have 5,000 open profits. Of course, you do not take the 5,000 US dollar in the calculation. So you leave it out because you want to be conservative when it comes to risk. So for the position size calculation, you never include the open profits or losses. And you only take the 1% from the 50,000, and that means 500 risk per trade. So 500 US dollar risk per trade. You put the 500 on a casino table. So now do the math. How many shares can you buy? Maybe you want to take a second and do the math, and then you get the solution on the next slide. Of course, so here's the calculation. You have $7 risk per share, you have 500 US dollar risk per trade, so the 1% from the total capital. And now you do the math, and now you can see 500 US dollar divided by 7 is 71.4. And again, you want to be conservative. Now you take only a position of 71 shares. So be conservative. This is an important recommendation from myself. Always, be conservative when it comes to risk management. So in that case, you trade only 71 shares. And now, just to make that sure, you can trade a much larger position. And if you now take the 71 shares and you multiply it with the entry price, so with the 105, you see that your position is 7,455, and that's around 15% of your capital. So 15% from the 50,000 US dollar you have in your account. So, and again, you can trade 15% position and only risk 1% of your total capital. That's the magic behind it. And you can see here 1%. That's only a very small fraction. When you lose 1% of your capital, you have 99% of your capital. So you can lose a lot of trades in a row, or you can lose many trades in a row without a big impact on your trading capital and without going bankrupt. And that's important here. You want to stay in the game, you want to survive, and that's why you only take a very small fraction of your total trading capital. Another big benefit of this 1% rule, or this percentage we use for position size calculation, is that it grows and decreases automatically when your capital grows or decreases. So let's take 3 scenarios. Scenario 1, you start with a total trading capital of 100,000. You have 10,000 open profits. Of course, you ignore the open profits and you only take the 1% from the total trading capital, so from the 100,000 here. And then in scenario 2, you now closed 2 successful trades. And now you add the 5,000 profits from those 2 successful trades to your total trading capital. You know, your trading capital grows now to 105,000. You still have 5,000 open profits here, but you ignore them for the position size calculation. And now you take 1% from 105,000. So, and now your 1% grows to, that's wrong here in that example, sorry, not 1,500, but 1,050 in that case. And you can see that it's automatically, because we are using this percentage, it automatically grows. And your risk is growing and you are able to risk more money. In scenario 3, we close 3 losing trades with a total loss of 2,500 here. In that case, now your capital decreases to 102,500. And maybe say we also have negative open profits, so we have open losses of 2,500. In that case, also you ignore the open losses and only take the 102,500 for the position size calculation. In that example now, your risk is adjusted to 1,025. So it decreases automatically. You also automatically reduce your risk when you are losing money. And you automatically increase your risk when you are winning. So a very good approach for position size calculation. Yeah, I already spoke about that a lot. Be a conservative risk management. That's super, super important. Plan always for the worst scenario. Your goal is to survive every setback. Your goal is to survive every stock crash, every stock market correction, every gap down you have in a stock. So you want to be really a conservative risk management, but aggressive when it comes to profits. And that means only use trading capital without open profits and losses. I already spoke about that a lot of times now in this video. And also this 1% rule, I showed you one slide ago. So this 1% rule, or this percentage rule in general, will lead to an automatically risk adjustment. So when your capital grows and decreases. And also 2 another recommendations from my side. do not use so much risk. 1% is enough. You saw that you are able to trade a 20% position with only risking 1% of your total capital. So, and that only depends on the stop loss, on the distance between entry and your stop loss. So the smaller your stop loss, the higher is your position size. And of course, you can use 1.2% or 1.5% or something, but not more than 2%. I really don't recommend that, because the losing streaks and the drawdowns will increase a lot, and it's much more harder to come back from deep drawdowns. So 1% is enough. I sometimes only use 0.5 or 0.75%. So just really start small when it comes to new positions. And also a very important rule is limit your position size. This is super important. A maximum of 20 to 30% is enough. Always calculate for the worst scenario. Always calculate for the scenario when a stock gaps 20% against you. I made a video about that, about big gap downs, how to handle that, what's the background, and how you manage risk effectively. But the longer you trade, you will have some big gap downs against you. And if you have a 20% position and it gaps 20% against you, it's recoverable. You can come back from such a situation. But when you have a 100% position and it gaps 20 or 30% against you, this is really hard to come back from a 20 or 30% drawdown. So make sure you limit your position size. I saw traders which took this approach of position size calculation, but never limited their position size, and they entered positions on a high margin account. So especially in UK with spread betting or with options or something, you can have a much higher margin. And they traded 150% positions, and then a position gapped against them. So, and they really sat in a big drawdown. So limiting your position size is very important, besides this position size calculation. Okay, I said that in the introduction that I want to give you a demo with a spreadsheet, and you can use any spreadsheet. It's a very simple formula. So you can use Microsoft Excel, you can use OpenOffice, or if you are an Apple user like me, you can use Apple Numbers. But I want to give you a demo with Google Docs, because Google Docs is accessible for everyone. It's free and it's really simple to use. And now let's switch to the Safari browser. And here is a very simple spreadsheet. You can see that I already entered the formulas here. So my total trading capital 100,000, the risk 1%, entry 100, stop loss 90, and automatically the number of shares and the percentage of my total capital is calculated. So when I adjust that, for example, to 200,000, you can see that automatically the number of shares, it's increasing to 200. And if I maybe change that to 70 and here to 50, for example, automatically the numbers are adjusted. And you can see in that case here I only have a position size of 4%. So, but let's take another scenario. So 100,000, for example, and we want to risk 0.5%, and we enter at 100, and we put a stop loss in at 95, and in that case we have 10% position from the 100,000, and we can trade 100 shares, only risk 0.5% of the total capital, so $500 in that case. So using a spreadsheet is very effectively and very easy to do, and I want to show you how you can do that. Well, of course, total trading capital, that's a number field and there's no formula behind that. I only styled the field correctly with a US dollar sign here. This is a percentage formatted field, so 1%, and these are also currency fields. So there is no formula behind that. The only formula is in the number of shares. And here again, so you can see here when I'm typing, you can see the formula I'm typing in here. So you start with a with a formula here, and so now remember again, you take the total trading capital without any open losses or profits, and you multiply that with a 1% because you want 1% from the total trading capital. In that case here, you multiply the fields B2, so B2 with B3. So very simple. And now you have to divide it through the risk per share. And the risk per share is the entry minus the stop loss. And in that case, it's B5 minus B6. And if we now press enter, you can see very simple, you have you can trade 20 shares. So that's really simple. And if we now take 100,000 here, so 10, you can see we have now 200 shares. If we now switch to the prepared demo case here from me, you can see that it's working exactly the same. And again, here is the formula: B2 multiplied with B3 divided through B5 minus B6. So very simple. So everyone should be able to do that. If you have problems with a spreadsheet, and to do that, you should take a course, and you should be able as a trader to work with a spreadsheet, because it's a very important part of your trading. So, and again, how much percentage is that? We also have a very simple formula for that. So you can see that here in the ready part. Also, it's always from the total trading capital, and of course it's the number of shares multiplied with the entry. So if we now take that here, so it's a number of shares multiplied with the entry, so that's the position size, and then we want to know how much is that from the 100,000, and of course it's 20%. I already formatted the field with a percentage style behind that, and now you can see you can trade a 20% position with 1%. It's very easy to set up, and I recommend to use that for your trading size, for your trading position size calculation. I have a much more experience as a trader, and I can do that in my head because it's not so complicated math, and I mostly entered with a 10% position, so I can do the math in my head. But I also have a spreadsheet with a position size calculator. It's really almost the same you can see here, and it's helping me a lot to keep my risk at the same amount. Okay, I hope that this video explained the background to you. So coming from the risk management and keeping your risk at the same amount, and also give you some insights how limiting your risk helps you to become more profitable as a trader, and then of course giving you the tool and some help to set it up for yourself. So I hope that this video helped you with that and answered a lot of questions. If you have further questions, so leave a comment here, or you can write an email to me. And as a newsletter subscriber, you can also use the subscriber forum and leave a comment in the forum for all the other members. So if you want to follow me, you can do that here, of course, on YouTube. And if you like that video, you can give them a thumbs up. And if you don't like it, give them a thumbs down. That's also feedback for me. And share it, or feel free to share it, of course, in your social media networks. You can follow me here on YouTube. You can follow me on Twitter, on Facebook and Instagram. But I recommend to subscribe to my free newsletter. I send it out every Sunday with trading tips and with 3 stocks from my personal watch list.